Good afternoon, everyone. My name is Michael Arbus. I am the CEO of Moomoo Canada. On the call today, we've got Kevin Davitt, Head of Index Options Content with the Nasdaq. Together, the two of us today will discuss how you can really use options as part of your overall investment strategy. We're going to cover a lot today. We're going to start with beginner strategies if you've never traded options before. We're then going to evolve to a more advanced discussion for those that want to get deep into index options and focus on some of the more advanced things like assessing volatility, understanding why volatility matters. And in today's world, let's just start by thinking about all the volatility we see out there. We've got trade wars, we've got elections happening, we've got tons of things happening globally. And as a result, the markets have been in a chapter of spiking volatility. And as an investor, how do you navigate that? Do you just buy stocks? Do you just sell stocks? Well, there's a whole other suite of tools for you to use as an investor to take advantage of making money using options. And that's what today we'll focus on. Just to set the stage for how we're going to run today, I'm going to start telling you a little about myself, about Moomoo, and what we do in options. And then I'm going to hand it over to the true expert, Kevin Davitt, who is going to take us through index options and quite a bit more. I think you're going to have a great session here of learning for those that are fresh to options and those that are experienced. And it's going to be interactive. There's also an opportunity to ask questions at the end. We're going to cover some common Q&A and take questions from the audience as well. So let me start by sharing my screen and a presentation that we've put together here at Moomoo. Okay. I am almost ready. Here we go. Technology is never perfect.
Isn't that the truth?
All right. Trading with Moomoo options. And on the call, as I've said, myself, Michael Arbus, and Kevin. I think it's really, I just wanted to check, Kevin, do you see my screen nice and clear?
I do, yeah. Express yourself through options trading.
That's right. And that is one of the things that I think is most important, expressing yourself through options trading. Options aren't complicated. They sound complicated. There's lots of math behind the calculation of how to properly price them. But this all dates back 10, 20 years when option trading was really, really complex and only for those that were sophisticated. Platforms like Moomoo have really democratized it and streamlined how a retail investor can just execute in one simple click, look at a chart pattern, and you'll see some more about that later. You can express yourself if you have a bullish stance on the market, you can use index options. If you have a bearish stance and think that volatility is going to fall because things are going to stabilize, you can use options to express that view. If you think the market or a stock is going to stay where it is and you want to collect some income, there's strategies using options where you can use a neutral strategy. And we're going to talk about that. But at Moomoo, we actually have 12 different option order types. And unlike any other platform, in my opinion, when you use Moomoo, you'll be able to do in one click what would take you 20 clicks and a lot more understanding on other platforms. We've really simplified options trading for you because we think it's really important that you have the same tools at your fingertips as professional investors. And we also have an exciting paper trading contest just for option traders that the Nasdaq and ourselves at Moomoo have been talking about on our social feeds. It's a chance for you to make some money playing around and learning how to use options, because that's what we'd like you to take away from this, that option trading is something you should be thinking about doing. And let's start with a real simple example. I think this is a conversation that you might have with a friend one day, if your friend didn't have a face or a body, as friends. But I think Tesla is going higher. Cool. How much higher is Tesla going? Well, it's $276 today. I think it's going to get over $300. Wow. When do you think it's going to get over $300? I think it's the next 30 days. So should I buy the stock? Do you buy the stock? What are you going to do now that you have your view? Expressed your view. Well, I only have $1,200 and a Tesla stock is $276. What am I going to do? You could buy a call option. You don't have to. You can get quite a bit of upside if your view is right. You can buy a call option with us. Here's that exact conversation said in options language, which with time you'll understand. I would like to buy a call option with a strike price of $300 in Tesla with an expiry date in 30 days from now. Click, click. How much am I going to pay for it? That's your option premium. And now you've expressed your view using options. That's a simple example.
And your risk is limited to what you paid for that option.
Exactly. Thank you. That is one of the best things about options is you know what your downside is when you're buying options. That's right. And one thing I think this is a point that I would like to make is that we don't want you to lose sleep over any of the things you're going to hear today that sound fresh. I spent 2 years in school learning how to calculate the Black-Scholes formula, which is one of the early quant formulas for pricing vol. Ignore all of that. I was originally hired to work on institutional trading floors on options and structured product trading teams in Canada. And you know what? Doesn't matter for how simple options trading is today. But when I got to the real world after all of that training and job stuff, it turns out people don't really talk about Black-Scholes. They don't talk about all these complicated subjects. They talk about what's your view on the stock, up or down, or what's your view on the market, what's your view on volatility, how do you want to express that view, click a button that meets a chart pattern, look at your payoff, and decide if you want to execute. It's now a couple clicks away. You don't need to, it's fun to understand all of that at night with ChatGPT if you really want to go down a rabbit hole. But like many other things, we're all busy with our lives today, and we just make things simple for you. And I'll quickly flip through here because I know this is going to be a great subject for Kevin. But it's the same principles in option trading. It's just you're buying low and you're selling high. It's just the thing that you try to buy low and sell high is volatility. And if you want to sound cool around your trading groups or your bar meetups with your friends, just say, yeah, I like to buy vol low and I like to sell vol when it's high and capture the premium. That's just something to remember for the future. And before I hand it over to Kevin, where you're going to learn quite a bit today, I'm going to play a quick promotional video that shows you basically what I've said today and how simple Moomoo makes option trading for you.
Profit whether the market rises or falls with options trading? If you're eyeing a Tesla rally, here's your easy 3 steps. Select your market direction effortlessly. Pin down your target price and the desired expiration date. In moments, you'll receive tailored option strategies with detailed profit and loss projections. Ready to trade? Just select an order. Plus, explore numerous other features, all free. Enjoy a full refund on commissions with the convenience of our multi-device support on Moomoo.
The mooing bull. It's one of our things. So thank you for paying attention to that. Again, the purpose there was to show you that have a view. I think it's going higher. I think it's going higher for this period of time, or have a view and you can express it with options. Think about that next time you're about to place a trade or making an investment or have conviction over something. You don't have to just buy and sell stock. And I will now stop sharing my screen. And Kevin is now going to take the stage and tell you a little bit about himself, I hope, because I'm looking forward to hearing this. And I'm looking forward to learning, so I'm going to mute myself and over to you.
Let me make sure I am off mute, correct? Good. Well, I'm going to disappoint you if you want to hear a whole lot about me. I do want to talk more about markets and the way you framed this conversation about the increased approachability of options generally. For the audience, I thank you for joining, whether you're listening live or taking time out to watch a replay. I think that speaks volumes about your interest in the power of optionality in a world where I think generally that sounds increasingly appealing. I'm broadly excited about the collaboration between Moomoo and Nasdaq in this options area. I'm thrilled to see that the global user base for Moomoo's tools is growing rapidly. As was just hinted at in that video, They have built out a really powerful platform that connects you as an investor to the markets. And they've also embedded super valuable education about those sort of views and how you can tailor them without being fully fluent in kind of the vernacular of derivatives, which can be off-putting. Education is a critical component, and I think that's why events like this are important. While it's not generally considered a great sort of jumping off point, it's my preference because I like to talk about risk in any given market. So we've moved on visually, and you see some standard disclaimers that are required, and they're important. But I think the message behind this legal jargon is more important. This is stuff that we know intuitively. There's risk in markets at all points and times. The problem is our reptilian brains prefer to focus on the potential reward and on that kind of greed side of the ledger, and that can be dangerous without proper education. Now, options. And I concern myself primarily with a niche within that world of index options. They are very flexible tools. They can be used in a variety of ways, and they are powerful. In my opinion, those that think first and foremost about the risk they might be assuming in a given position tend to be the most successful over the long term. That takes discipline, which is a message that extrapolates that discipline point well beyond this topic. Protecting and growing capital through time is difficult. If anybody tells you otherwise, they are full of it. But difficult things become much easier with discipline, and education about risks and potential rewards is key to that sort of overall understanding. So let's get into it. We have a handful of minutes today. I'm going to talk about options generally with a bit of a skew towards index options. From a professional standpoint, I did spend many years trading options on floors in Chicago and Philadelphia, then on screens in Chicago, and I continue to trade for my own account today. For the past decade, I have worked for exchanges as opposed to trading firms and mostly focused on index products. I'd like to think of myself overall as an advocate for the informed use of options and, when appropriate, for index options. After this session, what I would like is that you have a better understanding of the differences between equity and ETF options and index options. That's a key goal. There's a couple of important distinctions between them. And most importantly, I want you to feel comfortable asking questions. I want you to ask questions. Make this as interactive as possible because it's not about me getting through slides. It's about your understanding. And chances are, if you have a question, somebody else that's joined us this afternoon has the same question. So you'll make us better at our jobs in the future. Now, my goal isn't necessarily Options 101, but I would reiterate that point about you can dig into material in the platform. Tons of valuable information there. And then there's also a great deal of fundamental information available at the Options Industry Council, the OIC, which is a collaborative between all derivative exchanges in the US, and they're committed to unbiased education. It's fabulous. Now, historically, derivatives generally and options specifically were designed to manage risk, typically to offset a pre-existing price risk. Many in Canada, I'm just going to make some assumptions here, feel free to correct me, might be used to hedging their wheat crop or canola or energy pouring out of Alberta. That is often done with futures and options derivative markets. In the financial world, index options allow you to manage exposure to an equity benchmark, for example, the Nasdaq 100. Now, I shouldn't assume that everyone knows what the Nasdaq 100 is. I'll go into a little bit more detail, but in short, it's the 100 largest market cap names listed on Nasdaq exchanges, but it excludes financial firms. And I kind of wish I could do a quick poll, but in my mind, the question is something along the lines of, Does the audience associate US large cap equity exposure inherently with the S&P 500, or do they integrate other equity indices like the Nasdaq 100? Do you make distinctions between the two?
Yeah. Kevin, I think,
Michael, what just out of curiosity, what do you think the default is from your conversations?
yeah, I think with our audience of active traders, and in particular those that are option traders or option curious, they would know that the Nasdaq 100 is where they should be spending their time trading, where volatility, where liquidity exists. For the traditional hedging of long exposure to the S&P, it's great, but
Sure.
I think that this audience is well aware that the Nasdaq is where you're going to find the action.
I mean,
I did actually have a question,
yeah,
Kevin.
bring it.
I was going to say it's an example, and I just want to, I think tell me if I understand it correctly, but let's say I've got a portfolio and I'm long the Magnificent Seven. I like to play those. I follow them. I trade them on Moomoo. I actively watch NVIDIA, Tesla, and I find it's Friday afternoon, and I'm long a bunch. I've spent a lot of time acquiring a perfect portfolio, and something bad happens on Friday at 2 o'clock.
Okay.
I don't think that I want to reduce my stock exposure in the Magnificent Seven. I don't want to do 10 trades. How could I use the Nasdaq 100 option chain to express that view, or at least protect myself for the weekend if something bad has happened?
That's a good question. It is an expression that we see growing, and we could spend a whole lot of time. I'm going to try to distill this in the interest of time. I could send you a whole bunch of information about the degree of high correlation between the price performance of the Nasdaq 100 and those 7 or now 7 plus, if you're including Broadcom, those names and the index. So what you're describing essentially is a dispersion strategy where typically market participants will own idiosyncratic risk, the stock specific names, and they can offset that with the systematic side, and that's the index options. So let's just say you're alluding that you're concerned about downside in that group of names. If that happened, given the role they play in the index overall, the index would likely be lower. And what you could do is go into the front end that you showed earlier, say either bearish or very bearish, and see what sort of strategy is kicked out on the index, and then choose one that was appropriate without really delving into specifics, which I think is beyond the pale for this conversation. Does that help?
Yes. Yeah, that was great. And it leads to a little story. Back in 2008, 2009, during the financial crisis, when we were both watching the markets closely, there were days where you would see +5, +10, down 5, down 10, 3 days in a row of declines. And on the Monday, you'd show up and the market was up 10%. And I remember, the way you just described systematic risk and idiosyncratic and all those terms for a retail and new user. I guess the comment I'm making is sometimes you just say, I'm going to buy a short-term put option. Nice and simple. I'm going to go spend a few $100 and I'm going to buy something on a Friday. And on Monday, if I'm wrong and I lose a couple $100, so be it. If the world is going to fall apart for whatever reason, at least I'm going to maybe make back some of the losses I'm going to take on all my other positions. So I think boiling it all back, like you speak at such a great high level, and I really love it. When you're starting out, it can be a lot simpler. You can just say, I'm going to buy a put option. I'm going to hedge myself a little bit over the weekend. It's just one example of what we're talking about.
You couldn't be more right about that. I think it is increasingly becoming that sort of exposure continues to grow, and distilling it down, there is nothing wrong with that. And I would point out one thing, because you said perhaps I lose a couple $100, but if the world goes to hell in a bucket, I'm protected. A hedge is designed to lose money, right? Like you don't buy car insurance planning to wrap your car around a pole. your primary risk and your primary exposure is in the underlying asset. And so that's something that can be difficult for our brains to wrap around, but it's difficult but meaningful, right? If and when those things happen, and you can see outsized moves and relatively small dollar options turn into much more significant dollars. In terms of a sort of really fundamental, we alluded to this earlier, but with options, there are rights and there's obligations, whether you're a buyer or a seller. You buy options and your risk is limited to what you've paid for it. You sell options and the most you can make is what you have collected, but there are all sorts of ways to combine them as spreads that are defined risk, the nuance that you'll move toward. But understanding rights versus obligations is important. Ultimately, I think options are most powerful in the sense that you can exert greater control over outcomes. And to be clear, it depends on the strategy that you use, but I think there's a natural human desire to reduce uncertainty, and options can be used, like you just said. I'm uncertain over the weekend to reduce uncertainty, and that's a very powerful role that they play. Now, backing up and thinking about the big sort of philosophical backdrop, this illustrates long-term growth in options generally. I broke out a handful of sort of time windows on the left-hand side. Just from my understanding, I would say that the first 25 years in options were a fairly niche business. Michael mentioned that early on. Broad understanding was low. They were used by institutions and relatively few individuals, and the level of competition was nothing like it is today. Competition is a very good thing for end users. And then technology started to blossom and it impacted everything, every corner of the global economy, not just capital markets. I started in this business, going to date myself now, but maybe the bald head does it for me. Back in the late 90s, when 2 million contracts would trade on an average day. A couple of weeks ago, earlier this month, 100 million contracts traded in a single session. How have we seen this kind of growth? Technology most assuredly played a role. It reduces frictions or hurdles for access and information. You saw that laid bare in that quick video, how like quickly you can sort of distill this terminology using technology. Demutualization of exchanges played a role. I'm not going to bore you with that story, but it altered incentives in the business. And I'm a believer that incentives really can drive outcomes. The level of competition ramped up very considerably with an all electronic exchange coming online in the year 2000. That was the ISE, which is now part of Nasdaq, a firm, again, that I work for. I'm talking my book here, but a firm that's been driven by electronic trading and technology since the 70s and the inception of Nasdaq. And then what else has changed is education. The industry started to actively engage the world with education, how these tools can be used to potentially improve short and long-term outcomes. Then we saw pretty steady growth until the global financial crisis. More recently, the world changed in 2020. I don't know if you can see what I'm highlighting there. But in 2020, we've seen a huge increase in individuals using platforms like Moomoo to access options markets. And now we're at roughly 60 million options on an average day, which is exceptional. Now, the visual I'm going to move to, as opposed to all options, equity, ETF, and index, this is the growth of just index options. And as I mentioned earlier, I want you to understand the slight differences. Big picture, you see a very similar shape to the direction of average daily volume. The time frame is slightly different. Index options were introduced in the early 1980s, as opposed to the early 1970s with the equity options. Here and now, average daily volumes in index products alone make up nearly 5 million of the 58 million in the sort of current zeitgeist. But I want to focus on how and why index options differ from equity and ETF options. Now,
Before you jump to that, Kevin,
yeah,
I wanted to just say, when I see that chart, it gets me really excited, as I'm sure is the same for you.
of course.
This is why Moomoo's here. This is the world changed in 2020 when people are at home. And if for those of us that maybe watch the crypto industry as well, people can figure out ways of doing complex things when they see an opportunity. They can figure out how to use a less developed platform or read a lot and educate themselves on things where there's an opportunity. And what I see you showing here is technology coming into place, maturation of exchanges allowing execution to happen faster, and platforms like Moomoo basically, and education coming out of the Nasdaq themselves, basically saying this is something that you should do. It was the era of the retail trader, and I love seeing this, and this is exactly why we're having this call. You speak at a very high level, and this is great information for people to have. But I think it also says you're in the right place at the right time. Growth has just started to happen, and you today are learning about options and index options and the differences between ETF stocks and index options. This is great knowledge to have that's going to hopefully give you an edge when investing in the future, and you're doing it before a lot of your peers, which is what you want. I just wanted to make that point. I get excited when I see these charts.
I do too. Granted, we're part of the business and we've seen this evolution. One of
Right.
the other things that we haven't touched on yet, the video did very briefly, was that in this intervening time frame post-COVID, and it started with index options, you alluded to opportunity. And when options expire, there is arguably a greater degree of opportunity. What has happened is that we have introduced more expiration cycles. Essentially, every day that the market's open, index options will expire. And so there are in the ballpark of 252 opportunities. That does not mean you need to be active in 252 sessions. But let's say you were worried about elections in Canada, which just passed, or GDP in the US, or our jobs number on Friday. You can be much more precise about your exposure now, and people appreciate that increased flexibility. Now,
Right. I've heard those called zero DTE options. Does that sound an expression that you're familiar with?
it is, I think, much of the coverage, at least in the US, has been fear driven. We've had zero DTE options since options expired the first time in 1973. There are unique dynamics that need to be understood at expiration. Some of them we're going to talk about here, as far as like how a product settles, what that means in your account. But ultimately, at expiration, an option either has intrinsic value or does not. And we'll talk through some of those differences and why a number of people, why for one, daily options were made available on index products. In short, they're European and they're cash settled. We're just about to talk about that. And that makes it cleaner as far as expiration goes. So
So
I
I
have
can,
yeah, go ahead.
sorry, every day, pretty much every working day. So 252 after a month. So there's 365 days in a year, 252 roughly the markets are open.
Mm-hmm.
And on each of those days, I can express my view using an index option. I could have a view, a 1-day view or a 0-day view, and I
Correct.
can play on an option that's expiring today and express that
Correct.
view. Wow.
Yep.
Okay.
Just to be clear, I am not like necessarily advocating that,
Of course.
but it is the case. And I could, I have an option that will expire. I have a couple options that will expire later today. And that opportunity exists every day that the market's open. Why is this available in index products? Index options, well, for let's understand what makes index options unique from equity and ETF options. Aside from the number of expiries, there's a handful of things. One, index options come in a variety of notional sizes. Now, I do not want to confuse anyone with technical jargon, so let's just quickly understand basic notional exposure. If you take the value of an underlying, a reference asset and then multiply that by the contract multiplier, which across all equity options is 100, then you get the notional value of an option. So if the Nasdaq 100 is measuring 19,500 and each option controls 100 units, 100 times 19,500 is like 1.95 million in notional exposure. That's a big product. Talk about Apple. Earnings later this week, right? Yeah, Thursday, I think.
Yeah.
Stock trading around 210 USD, options control 100 shares, notional exposure per option, $21,000, 210 times 100. Microsoft is up around 400, also earnings this week, so the notional exposure of a single option there is 40,000. Going back to the Nasdaq 100, and visually on the screen here, you see XND. That is an index that also tracks the Nasdaq 100, but at 1/100th the size. So XND will measure around 195 when NDX is 19,500. And so the notional exposure is much more approachable for many people. Now, moving on, I'm going to be brief.
It's okay. So if I want to go express my view, I think I want to go long the Nasdaq 100. I don't have $2.1 million to make that happen. I also don't have $22,000 to do 1/10 of it. So I think what you're saying is I can get $22,000 of exposure by buying an option.
Correct.
One contract will give me 20. Oh.
That is the somewhat fancy word, or when you're sitting around the bar or whatever talking, that's the leverage inherent in leverage is inherent across derivative markets. That leverage can differ. It is meaningful. And that can be both ways. Like when you own an option, that leverage is working for you. I don't want to, overly get in the weeds right here, but that is a powerful motivator where myself included, like I'm not able to go out and buy 100 shares of Microsoft at a clip. Like that's $40,000, but I can get exposure to it for a discrete time frame in a very limited dollar risk way by buying a call option, buying a put option if I'm worried about the downside. That's powerful.
Yes, and for Nasdaq, for people that are going to go down the rabbit hole of trading index op, make sure you add to your watch list X on Moomoo, XND, QQQs. I would watch the NDX as well, but you know that you can probably trade the XND options on that quite easily and maybe get quite a bit of leverage if you're right.
And then let's then focus on the differences. If we're focused here on the left-hand side, there's a slight notional difference between, given the price of the Qs. If you want to go into the math, the Qs are roughly, if you divide the Nasdaq 100 by 41, that's roughly where the Qs are going to trade. But the two major differences are European versus American cash versus physical shares of the ETF. What does that mean? Well, cash settlement, which is how index options are settled, means that if an option has intrinsic value at expiration, the value of that option will end up in your account. So let's give a quick example. NDX options will expire later today. Let's imagine the index settles at 19,550. And you owned the expiring 19,500 calls. They are worth 50 based on that settlement value times 100, so $5,000. If you paid less than that to buy the call option, you're up, not including frictional cost. If you paid more, you've lost some money, but it just settles to cash. Now, in the QQQ, let's say you own, I'm going to translate the equivalent strike as essentially the 475 strike call, and the Qs settle around 476. That call option is in the money. You have the right and the economic incentive to buy stock at 475. You don't end up with $100 in your account, which is what that option is worth at that point. you end up paying $47,500 to buy 100 shares of the ETF at the strike price. That is physically delivered shares of all equity and ETF options at expiration. So you're out of pocket for the shares and you have directional risk going forward. Many people, not everyone, prefer that cash settlement features. Others look to manage underlying securities risk. The choice is yours. It's, no pun intended, but another option. And if you just prefer to manage options exposure, then cash settled index products may be right for you. Like, I think about the dentist. I need to go to the dentist. And if I don't want to be worried about trying to roll out of a position, if I happen to still be at the dentist on an expiration day, I like that it's about, it'll just be cash settled. For those that are, then the other side of the ledger is the European styling of options. So what does that mean? They don't have fancy language. It just means that they can't be exercised or assigned ahead of expiration. Now, I don't want to make too much out of that. Roughly 6% of all options are exercised early. But if that does happen to you, and it can happen in the QQQs, the ETF, or any equity option, it's likely because an option is in the money and somebody is trying to collect a dividend. If that happens to you, you are responsible to pay the dividend, and you'd end up short if you had sold a call. Anyway, it's a relatively small risk, but it can matter. Do you have a question there, Michael?
I do, yeah, and a comment too. I remember I'm over 50 now, but when I was 20 and first studying options, I remember going to the textbooks and looking at the chart patterns and saying, I don't know what this means, and then looking at American versus European. That was always one of the things that would be early in your textbook knowledge of trying to understand options. And the way that you phrase this is just brilliant. For those that maybe haven't thought about this before, I think that the message that Kevin is being very humble about saying is that the NDX contracts, option contracts, have much less challenges at expiration if you've made money. And maybe that was by design. And when comparing it to the QQQs, which are quite a popular trading product as well, trade the Qs if you want, look at NDX if you want. But I think if you're going to trade options, I think where we're headed is saying something that is a European cash settled option is probably a lot easier to manage than a QQQ option, American option that could be taken away from you at any time, where you might have to fund a dividend for somebody and you might have to send a whole bunch of money to get money back to make that $500 you were talking about. So I think that's a great point about NDX, and I am going to be putting that on my watch list for.
And again, if NDX, because the premiums on a high value index can be off-putting for many market participants, myself included, take a look at XND and keep in mind that you can, in the ecosystem around the Nasdaq 100 is massive. You can often get filled right around midpoint. I don't know how much education Moomoo users are, but let's say you just have a bid offer spread of $1 at $2, you can likely trade that option around 150, particularly in liquid index products. So something worth mentioning.
Yeah, they're liquid. You get a fair price.
They are index. We have arguably the second most liquid derivative product in the world, and we're aiming to be number one someday. That's part of my work. But I think the other part of it is driven by performance. And that's not the only thing, but it certainly draws interest and attention in the NASDAQ 100, given years and years of outperformance. I know that we have choices with respect to so many things, and sometimes that can be overwhelming. But options are valuable in the general sense of the word. But your choice with respect to what index your passive or active investment dollars track can matter a great deal. Like, I'm going to jump ahead just a little bit here to this one. And this is just showing since the financial crisis, right? The performance for the Nasdaq 100, let's say up about tenfold, 1,000%. The S&P 500, nothing to sneeze at, but dramatically outperforming. And then you look at some other global markets, and I didn't put like TSX or Canadian benchmarks on here, but generally they have lagged. And it has been a powerful driver of interest because performance matters. Now, granted, that's not necessarily, you're not going to likely have an option in 2009 that expires now that's captured all of that, but it has been meaningful and delineating why am I investing and what index matters. That's really the point I wanted to make there.
Great point, Kevin.
Good. Did you have
in
anything?
Canada?
Yeah.
Sorry to jump in, but we have it's one of the things that we sometimes talk about here is that Canadians tend to have most of their assets invested in Canada, and we think that Canada represents 2% of the world MSCI roughly, and that balance is wrong. And that's part of what we've provided Canadians is this tool that allows them to easily access US equities and now US options. And being underinvested in the Nasdaq over the last 20 years, to your point, has been a huge loss of return that unfortunately many Canadians experienced. So it's really nice to have this chat today talking about another way to maybe get caught up with some leverage, with downside risk protected options on NDX options. Anyway, sorry, continue. I just wanted to point that out. This is wonderful.
Not at all. I appreciate the input. I think we're seeing that globally, that, well, it's interesting that there's been a little bit of a reversal this year with like US underperforming. But when I think over longer time frames, people want access to the most vibrant, most liquid markets, and that's no knock on Canada whatsoever. But the drivers of technological and economic growth for the better part of this century have been US domiciled. That could change. Again, I want to be very mindful there, but some exposure, just like for me, some exposure to international markets can be beneficial. So I'm not all in US, can be meaningful. In the interest of time, like I want to leave some time for Michael and for audience questions. But when we talk about an ecosystem, the ecosystem that's developed around the Nasdaq 100 is really, really robust. There's some big numbers here with billions of notional traded, and how all the individual single name equities that make up the Nasdaq 100, that there's a futures component, all sorts of options. It all matters and feeds into your ability to get the most competitive pricing, the most competitive bid-ask spreads in the market available to you, streamed through a powerful platform. And in terms of these products specifically, NDX options volumes are up 40% year over year. They're up over 100% over the past 2 years. XND is growing even more rapidly, right? Like I don't mean to speed through this, but I want your questions, and you're going to have my contact at the end of this. Here's NDX monthly volumes. Again, thinking about NDX, you are getting very, very significant leverage of nearly $2 million of notional exposure with whatever you're paying for an option there. The higher volatility, and I don't want to overstate that, over long time frames, the volatility premium of the Nasdaq 100 relative to, for example, the S&P 500 is quite small, roughly 3 vol points. For those interested in short-term, more opportunistic trading, that elevated volatility can actually be a draw. Now, it can be off-putting for others, and when you have stretches like we did earlier this month where both indices were moving 4 or 5% on any given day, that type of volatility can be off-putting no matter where you are. But it can be powerful for much of the year. Here is sector exposure through time. As you've likely heard, the Nasdaq 100 tends to be information technology heavy, followed by consumer discretionary. I would imagine that many Canadian portfolios skew resource rich. And this could be used as kind of a barbell there. Again, I'm painting with a broad brush here. And I want the users, the listeners to understand, there we go. Okay, XND. There can be misunderstandings with these micro products, right? Like, is it the same thing? Is it different? I don't get it. Here's one of the ways I like to explain it. Pepsi happens to be like a top 10 or 15 holding in the Nasdaq 100. And XND is sort of like the 20-ounce bottle of Pepsi, right? You just need a single serving that's appropriate for me. I don't need the 30-pack for a party. That's sort of like the distinction I make between NDX, the big product, and the single serving, right? It's the same. I'm from Chicago, so it's pop. Maybe you guys call it soda.
No,
It's the
pop.
same underlying, but just a different size delivered to you. And so if the NASDAQ 100 closes up 1% today, the XND index will move up 1% as well, but your dollar premiums and your notional exposure will be significantly smaller. Again, understanding your alternatives, whether it's the Qs, the NDX, XND, or other products is key. But there has been a growing demographic that wants the potential benefits of cash settlement, European styling, all these expirations with a more approachable premium. And this is serving that area of the market. Long-term growth, this sort of goes back to the opportunity has been in the NASDAQ 100. If you look at standard deviation numbers, those are essentially a distilled vol measure, annualized over a long time frame, roughly 19% versus 16%. That's your 3-point difference that I was alluding to. Big picture, I think about this question, is volatility good, bad, or indifferent? Well, it's omnipresent, but the level of volatility ebbs and flows. Michael, I'm curious whether in the data that you might be privy to, whether you think the audience and Moomoo user base is excited by stretches like we've had over the past month, or is it off-putting?
Yeah, I mean, we could look at it in multiple ways, but we start by looking at how many new users are coming across to a platform like a Moomoo. So a platform designed for flexibility, ease of trade, low cost, high value, high education, one click to do things that on Canadian platforms and our competitors would take 10 clicks and a ton of knowledge. We see in moments of time, for example, US elections, massive inflows of growth. All throughout last year, when you see trade wars being announced, it's another time. And we link the decision to our marketing team too. When do we spend our marketing dollars? And we time it to chapters of volatility, because we know people care to learn where they can express their views more cleanly and efficiently. So, I guess the one thing from that slide for me that jumps out is I thought that the Sharpe ratio, these measurements of risk and return and volatility, that the spread would be a lot more. Well, the S&P 500 is supposed to be boring, and the Nasdaq.
I appreciate you saying that. Without getting into nuance or too much nuance, upside volatility is volatility too. And investors typically don't associate upside volatility with that's a volatile market. But when the market goes up, let's say 2 years ago, the NASDAQ 100 was up like 53% for the year. That's volatility too, and it shows up in that standard deviation number. But Sharpe ratios are comparing like drawdowns relative to vol in like super simple terms. And what we have observed is that there are meaningful periods of upside volatility in the NASDAQ 100 where you see significant outperformance relative to other indices. Thank you for drawing attention to that.
It's not
higher
as risky
Sharpe
as
ratio is a
thinks.
good thing.
Right. Now we're down to our final 10 minutes. I just wanted to highlight that.
Me too. And I would like to stop sharing and let
Oh,
us and
I didn't want
engage
you to. I
the.
wanted more. That
Oh
was
man,
incredible.
there's plenty more. There's always opportunities to learn more, but I want to make sure that your user base has an opportunity to ask questions. We can pull slides back up, whatever needs to be done.
Yes, I'm going to go quickly through a couple of things that I thought were interesting that I wanted to get out. And then I've got a few questions for you that have already come in from users. What we've talked about today, looking at the product, which would be the NDX. I think that's the biggest takeaway from your speech, Kevin, is that the NDX is not something that I had spent a lot of time thinking about it, but I get it now. European exercise, tons of liquidity, 252 expiries, if I have it right, put on my watch list. And if I want to express my view, there's tons of opportunity with not having to spend so much on a $2 million contract. I can do it for 22,000 exposure. So that was,
or a spread like your examples here. Vertical spreads are hugely popular in our product. A $10 wide spread is a $10 wide spread no matter what product you're looking at. And we see tons of spreading in indexes.
right. Well, and I guess I'm going to flip real quick here, but the way you would on Moomoo's app, it's brand new. This is something that I think you'll really enjoy as someone who's learning about options. If you think that a stock is going higher, you don't just have to buy a call option. You don't have to just buy the stock. There's lots of different ways to express that bullish view. And here's just an example of them. And you can learn all about these. You'd click on the strategy and you would execute. There's also bearish strategies. If you think things are going down, you might not just buy a put option. That's grade 5 or grade 6. When you want to get up into university level stuff, you've got a few different strategies that you can deploy. And those are available for you to learn about and in one click execute on Moomoo. And these are some of my favorite strategies when things are boring. And I know and volatility is high. So we've just finished a chapter in time when volatility is remaining high, and you can collect money. You could be neutral, collect money and hope that the market goes nowhere or that a stock goes nowhere. And you can collect money, and that's an income strategy you might have if you think things are stable. And then finally, what if you don't know if the market's going up or down? What if you want to take a bet that things are going to, whatever is happening, I think that the market is going to go crazy up or down, and you can express that view with options too. And they have some really cool names. So if you ever drop an iron condor in this options bar that we've been talking about, Kevin, I think you're going to probably be promoted to mayor
Some
of the
new
bar.
friends.
And then finally, I had an NVIDIA example, but we saw NVIDIA fall off and then hit a bottom and then it spiked. What could you have been thinking at the time if you were bullish and thought it was moving higher, or if you weren't sure, bullish or bearish? You could have used a straddle or a vertical spread. And these are things you can learn about. And Kevin and I could talk to you for a very long period of time. And finally, before we go to Q&A, we're having a paper trading challenge. The Nasdaq is talking about this challenge. We're talking about this challenge. You can make some money. We really want you to learn how to trade options because we really want you to be a part of the future and earn income and express your view and use the NDX. And I think that concludes the official speaking points. And I'm quickly, with a few minutes left, 7 minutes, I'm going to turn to questions. Give me 1 sec to check the boards.
Yeah.
Okay. This one is for you, Kevin.
Okay.
Most Canadians think options are hard to invest in because they don't understand how they work. What do you think investors are usually afraid of?
What do I think investors are usually afraid of? I think not only investors, but humans generally are afraid of, I don't know, of things they don't understand. And I think if I went back to that slide on the relatively dormant growth for 25 years in the early stages of options, that was the issue, is that so few people understood. Now, without being too much, I'd say that there is so much information readily available to educate yourself on, and you don't need to spend 6 minutes thinking about Black-Scholes on the basics from which to jump off. Sometimes I make the analogy of golf, where like you could be on the range hitting balls all day long, but until you go out there and you play a couple holes, you're not going to really learn a whole lot about the game. And I'm not saying be cavalier, but people are afraid of what is unknown. And you
Yes.
change that by doing something small and measured and having guardrails in place to find risk. And so I think that it is very natural. I think some of the the PR around derivatives took it on the chin post global financial crisis. If I had another 15 minutes, I would rail on why that was inappropriate. My short take there is that for someone like Warren Buffett to say that derivatives are instruments of mass financial destruction, it's ironic given the fact that their primary business is insurance, which is in large part how these products work, and that Berkshire Hathaway is one of the largest options traders in the world. Moving
Yeah,
on.
they're the house.
Mm-hmm.
It's like a
Mm-hmm.
Vegas casino saying, don't be a casino.
Yeah.
Don't be the house. Okay, well, that was a great answer. And then I would say what I loved about today's presentation is seeing that, like you mentioned, the number of contracts that are trading daily now and the interest from all around the world. And we see that with our 25 million users. It's happening. Options are mainstream now, and there's only a few places that make it easy. And you just have to decide when you want to put that pin in and start learning and thinking about the Nasdaq 100 based on what we learned today too. Can options be part of a long-term investment strategy, given that
Ooh.
what we hear most of the time is that options are short-term investments? What
Oh, I
do
love
you think?
that.
Mhm.
You're so right. The coverage of the use of short dated options has garnered too much attention. The short answer is most certainly. I think the most obvious place where we have seen that is the outgrowth of structured product like ETFs, where they are typically designed to track an index. Many of them are designed to track the Nasdaq 100 with some kind of buffer and typically an upside cap. And they are point to point with 1 year maturities. So as you think about the aging population in the US and the Canada, say you want to remain invested in equities because the opportunity there, but you can't stomach a 20% drawdown in your nest egg. Well, there are products with an ETF wrapper now where you can say, I'm long the index, I am protected against the first 20% in downside, and the most I can make on the upside is, I'm picking a number that's typical in the Nasdaq 100 for that buffer, is like 13.5%. Many people will take that trade-off. Behind the scenes, index options are working to do their thing, and this is all happening within a wrapper with long-term time horizons. The other thing is insurance operators, annuities, indexed annuities, and those are people that use index options with maturities anywhere from 3 to 10 years in the future. It is another growing area, the other side of the barbell.
Yeah. And for retail people, I mean, there's lots of strategies we hear come up, and I'm sure you know them well, Kevin, but a stock falls down and it's a blue chip stock and the world's okay, you can sell a put and collect income
Yep.
if the stock stays there and goes up, it's an income strategy. If you bought stocks 30 years ago or 20 years ago and they're all up 100% because you timed the market right, luckily, and you don't want to sell and trigger a capital gain and pay taxes, but yet you want to reduce your exposure, XND, if you're holding the Magnificent Seven, have a bear short-term strategy. So there's actually some mitigation of tax that we can use too as a retail
Good
investor.
point. Good point.
Yep. And I want to turn, there's one thing that I think is worth noting is that at Moomoo, we've dropped our pricing to 65 cents a contract with a minimum order of $1. So we have really placed our flag in the ground and said, we want the options community. We want to do calls like this and bring value to our users. We want to learn about it, and we want to make it really affordable for people to execute with low costs. And that's what we're about. And now I'll turn it to a final question. Where do you think, this was an opinion question from a user, so I'll try to rephrase it, but volatility has been going up and down and sideways. What's the long-term trend in volatility, and why does that matter for us as retail traders?
Oh, it has gone up and down, which is not unheard of, but The bigger picture question is one I wish I could answer. My sense is that we will likely see a higher floor or a higher low in overall volatility levels for the foreseeable future, given the degree of uncertainty just more broadly, without getting into anything political there, that we likely won't see volatility levels move back to 2024 lows, and certainly not like 2017 lows. Just my opinion. But there are opportunities in sort of every type of vol market. And I think when understanding that when volatility moves up, owning options is generally beneficial. That optionality when vol moves up is powerful. And we've gotten a bunch of reminders of that more recently.
Yes. And this is just, I never talk personal trade, but I'd share a little story when, we're busy at work, you and I, so it's very hard to actively follow your trading portfolio, and we should focus on our day jobs. But when there was a Chinese response and a trade war brewing over the last couple of weeks, and the market sold off and volatility spiked, vol was high, and I luckily, for whatever reason, sold a contract that was linked to vol, and it took a couple of clicks, collected the premium, vol fell, and I covered. So I got very lucky on calling that volatility spiked really, really high above its historic average. This is a whole other, maybe we'll save that for our next conference together.
Keep them wanting more, right? Bring it on.
That's right. Well, Kevin, thank you so much for being here today. I've noticed that you put into the chat a way for folks to get in touch with you.
Yeah, I did. That was one of the slides I didn't show, was that our group can be reached at Index Options, all one word, Index Options, plural, at Nasdaq.com. Happy to address your questions. It is legitimately part of my job. Bring it on, anything index or options related. And then I'll just reiterate, I've got a handful of friends at the Options Industry Council. They are great about overall derivative questions. And I know Moomoo has a great team as well, and that the education available now in the app is super powerful. So thank you, Michael, and thank you to everyone who tuned in this afternoon.
Yes, and have a wonderful day, and good luck trading the XNDs and all of the new products you learned about today. Take care, everyone.